Let's talk about a major geopolitical risk. What would actually happen to the US stock market if a critical global oil route, the Strait of Hormuz, was suddenly shut down? It's a massive question with huge implications for the entire global economy. Today, we're going to walk through a detailed analysis that models exactly that. We'll look at the risks and the potential outcomes for US stocks under a blockade scenario.
Okay, before we dive into the numbers, we have a quick but important note. This presentation is a direct informational narration of a source document. It's for informational purposes only, so it isn't any kind of investment advice. We're simply breaking down the research to understand its findings. You can find the full professional risk disclosure in the description below.
So, how are we going to tackle this complex topic? Well, we've broken it down into 6 key parts. First, we'll cover the risk disclosure and the analytical framework being used. Then, we'll explore a fascinating concept called the U.S. energy's structural paradox. After that, we're going to game out 3 potential blockade scenarios, a short-term, a medium-term, and a long-term closure. And to wrap it all up, we'll look at the conclusion and a potential execution strategy for navigating this kind of uncertainty.
All right, let's set the stage. In today's volatile geopolitical climate, the Strait of Hormuz is way more than just a shipping lane. It's a massive pressure point for the global economy. When tensions rise there, investors really need to move beyond gut feelings and look at hard data. And that's exactly what this framework is designed to do. It stress tests the S&P 500 against a potential oil shock. Now, the goal here isn't to sound an alarm, but really to provide a clear, data-driven roadmap for what could happen in an extreme scenario.
So, to measure the impact of a shock, we first need a starting point, a baseline. As you can see right here, in a normal world, without a major oil crisis, the S&P 500 is projected to trade somewhere between 61.32 and 74.97 by 2026-2027. The median valuation is right around 68.13. Just think of this as our anchor. As we walk through the different blockade scenarios, you'll see how this baseline gets pulled down.
Okay, this is where things get really interesting. You might think that because the US is such a huge oil producer, it would be pretty much immune to a crisis in the Middle East, right? Well, it's not exactly that simple. And this brings us to a fascinating contradiction the report calls the US energy paradox. The bottom line is, despite our energy independence, the US economy really can't escape the fallout from a global price spike. Let's dig into exactly why that is.
And this paradox isn't just some small quirk in the system. It's actually rooted in some very deep, fundamental contradictions within the U.S. energy system itself. So there are 3 core reasons for this paradox. First off, there's a mismatch in the type of oil. You see, a lot of U.S. refineries were built to process heavy, high-sulfur crude, the kind we often import. But the oil we produce here in the States is mostly light and low sulfur. It's kind of like having a diesel engine and trying to run it on regular gasoline. So even while we're exporting our own oil, we still have to import that heavy crude just to keep our refineries running efficiently. Second, there's a major lag in expanding our refining capacity. It can take 5, even 10 years to build or retool a refinery. And on top of that, energy companies aren't exactly going to spend billions on new infrastructure for what might just be a short-term price spike. And third, all of this pressure gets transmitted right back into our domestic economy. I mean, sure, oil companies might make huge profits selling oil at high international prices, but back home, the cost of gasoline and other products skyrockets. That squeezes household budgets, and it puts the brakes on the entire economic cycle.
Okay, now that we understand the underlying vulnerabilities, let's dive into the first potential scenario. What happens if the strait is closed for a short period, say 1 to 2 months? The report calls this a pulse shock. You can think of it as a sharp, sudden jolt to the system, but one the market can usually recover from pretty quickly once the initial panic subsides. Let's have a look at the numbers.
So how likely is this? Well, as you can see, this short-term scenario is actually considered the most probable outcome. It's got a 60% chance of occurring. This is basically the market's consensus expectation if a blockade were to happen.
In this kind of short-term closure, oil prices would likely spike into the $100 to $110 per barrel range. And in a moment of extreme stress, they could even touch 120. Just to put that into perspective, that's a significant jump that everyone would feel, both at the gas pump and in the rising cost of everyday goods.
And what does that do to the broader economy? Well, GDP growth, that's the overall measure of our economic output, is projected to slow down by about 0.2 to 0.4 percentage points in 2026. Now, that might not sound like a huge number, but even a small slowdown on a national scale can have a very real impact on jobs and business investment. Now for the stock market. A spike in energy costs directly hits company profits.
We're looking at what's called EPS, or earnings per share. In this scenario, S&P 500 earnings are forecast to drop by about 1 to 3%. And that kind of hit to profits could cause the index to fall by about 10%, but the analysis suggests it would likely find a floor and stay above the 6,100 mark. So if you're an investor, how do you navigate this? The report suggests a two-part logic. First, be cautious with defense and energy stocks. They likely jump at the first sign of conflict, but they could pull back just as fast once the situation cools down. The real opportunity might actually be in the reversal. You look at the sectors that would get hit the hardest at first. We're talking airlines, cruise lines, and online travel companies like Airbnb or Expedia. Once the crisis appears to be resolving, these beaten-down stocks could present a powerful rebound opportunity. All right, let's ramp up the risk a little. What if the blockade drags on, lasting anywhere from 2 to 6 months? This is where the market's thinking shifts dramatically. We move beyond a short-term disturbance and into the serious risk of stagflation. And that's a really toxic economic mix. You've got stagnant growth, meaning the economy is stuck in the mud, combined with high inflation. It's one of the toughest problems for policymakers to solve. The chances of this playing out are lower at 30%, but that's still a very significant risk, one that investors absolutely have to take seriously. In this scenario, oil prices don't just spike, they stay high, hovering in that 110 to 120 range. When high prices stick around for months, people and businesses start to believe inflation is here to stay, and they change their behavior accordingly. This is what economists call de-anchoring inflation expectations, and it's dangerous because it can create a self-fulfilling spiral of rising prices.
The economic damage here would be much more severe. GDP growth would slow down dramatically. The Federal Reserve, which might have been planning to cut interest rates, would be forced to slam on the brakes. For the stock market, you're looking at a 3 to 5% drop in company earnings and a potential 15 to 20% decline in the S&P 500. That would pull the index down to the 5,400, 5,500 range. And the PE multiple, a key measure of how much investors are willing to pay for stocks, would also shrink as confidence just evaporates.
Now here's a crucial warning from the report: the defensive trap. In a serious market downturn like this one, even traditionally safe stocks aren't immune. Why is that? Because if the market drops close to that 20% mark, big investment funds like ETFs can face a wave of investors pulling their money out. To pay them back, the funds are forced to sell their holdings, not because the stocks are bad, but just to raise cash. This forced selling can drag everything down, even high-quality companies. In that kind of environment, the only truly safe haven is cash.
And that brings us to the third and final scenario, the worst case. What if the blockade lasts for more than 6 months? The report calls this an extreme gray rhino. Now, unlike a black swan, which is a totally unpredictable event, a gray rhino is a highly probable, high-impact threat that we can see coming that often choose to ignore. In this situation, the global supply chain doesn't just bend, it breaks. Let's walk through what this extreme stress test looks like, based on the table. For the crude oil price, the extreme reading is anywhere from $120 to $200 a barrel. The logic here is that this is a production cost level that simply can't be sustained over the long term. For GDP loss, U.S. GDP would be reduced by 1 to 2%, while global GDP would fall by 3%. This is based on an extreme blockade simulation lasting more than 12 weeks. Debt to GDP would rise about 118%, which is a credit threshold that could trigger foreign selling of U.S. treasuries. And finally, for equity market performance, we'd see confirmation of a bear market, a drop in excess of 20%. The S&P could fall toward 4,800, with even a 40% crash risk on the table. In a devastating scenario like that, the Federal Reserve would be completely trapped. Its only real move would be to hike interest rates aggressively to crush inflation, even knowing it would cause a deep recession and widespread job losses. So, with all these potential risks on the table, what are the key strategic takeaways? Let's move to our conclusion and a framework for navigating this uncertainty. The report lays out a 4-point execution strategy. First, it identifies a critical decision pivot right around the 1.5 to 2-month mark. If the crisis starts to ease around this time, it could be an opportunity to start buying into the dip. Second is having conditional exit discipline. If the blockade approaches that 2-month mark and things are getting worse, not better, the strategy is to decisively sell any positions you bought. The key thing to remember here is that in a prolonged crisis, cash is king. Third is the principle for selecting securities. The focus should be entirely on earnings. You hold only high-quality companies that can still grow their profits, and you get rid of anything speculative or with negative earnings. And fourth, sentiment validation. Pay close attention to things like weekend market indicators. They can be a great tell for how markets will react when they officially open on Monday. And that brings us to a final, crucial point from the report, which you can see on the screen. The core of any good macro strategy is being able to revise your views dynamically. No model is ever 100% accurate, but when a major crisis hits, having a rigorous, data-driven framework is your best defense against being swept away by fear and panic in the market. And as a final reminder, this has been an informational breakdown of a research report. For that full professional risk disclosure, please see the description below. Thanks for watching.